everyone, welcome back to my channel. I'm your host Miss KK and this is The Wave. It is your weekly show that looks at topics related to personal, family and business finance, and our hope is that by the time we get to the end of this conversation, you are really better equipped to make sound financial decisions. If you are new, thank you so much for stopping by, and if you're already a returning subscriber, an awesome appreciation. Today we are picking up on the retirement conversation, and this is part 2. If you haven't done so, please check out the video I did last month where I discussed what is retirement and why do we need to save for retirement, what the various products are available on the market, the different tax implications, and at the end of that video I promised to bring forth a video around the FIMA Act changes. Whilst I'm not going to be discussing in this video whether the changes are good or bad and whether Namfisa has done proper consultation, which seems to be the debate on social media, I am going to be highlighting what the main changes are. I believe a lot of us are aware about the mandatory preservation rules, but I just want to just highlight out here that that is not the only thing that is changing, and unless we are informed about the proposed changes, we are unlikely to contribute constructively to the conversation. Namfisa has made these changes and has come under criticism, especially around the consultation and the parties involved. The general public feels that the consultation was not inclusive of the various stakeholders. If I can just mention here, the people that are really affected by this FIMA Act changes are the retirement fund themselves, are the board of trustees that are managing the business affairs of the funds, are the members, and are also the various service providers, which is your asset managers that actually are in charge of investing our money and making sure that it actually generates the return that we need to make sure that we are able to live comfortably in retirement. So Namfisa has now reopened the consultation opportunity, and I would like you, if you are a member and there's an opportunity for you to contribute to the conversation, please do so that you're actually contributing at the platform where your voice is likely to make an impact. So if your employer is giving you a platform, or if your retirement fund is giving you a platform, please participate in those conversations, because those are the conversations that are likely to matter. The first change that I want to discuss here is that retirement funds are not going to be automatically considered retirement funds in the new FIMA Act changes. They would need to reapply for registration. So what this means is that within 12 months of the Act coming into effect, and that is envisaged to be around October 2022, they need to make sure that they revisit their policies and regulation and make sure that they are consistent with the FIMA Act changes, and they need to reapply for registration. So failure to do so, you won't be considered as a retirement fund as part of the new Act. And also, if you don't revisit your policies and regulation, you could actually get your application rejected, which will obviously have severe impact for your members, because that means your members are actually contributing to a fund that is not considered a retirement fund under the new FIMA Act change. So that is the one change that is likely to affect the actual retirement fund themselves. One of the other changes that are coming through is actually positive for the members of the various retirement fund, because it actually is giving the right of the members of the fund to actually appoint at least 50% of the board of trustees. It's very important, and it's actually a positive thing that members will be allowed to elect at least 50% of the board of trustees, because the board of trustees are the ones that have the power to actually affect the business of the retirement fund, meaning the board of trustees are the one that approves the asset managers that the fund needs to deal with. They are the ones that approves the fee structures that we are actually charged. They are the ones that approve to the various asset classes that the fund is actually allowed to invest in. So this is actually going to be a good thing, because we as members now have the right to make sure that we are appointing qualified people, we are appointing people with the relevant expertise, and we are appointing people that have our interest at heart. So that is one thing that I would like to highlight here. So if the changes do come into effect as is, make sure that you are watching out for those board of trustee appointment. Normally they run on a rotational basis. I don't know if they're currently running on a yearly basis or they run maybe on a 3-year tenure. So do watch out for those notices so that you're actually voting when the time is due. Another change that comes, which affects employers. So now we've discussed the changes that are affecting the retirement fund themselves. We've discussed the changes that are affecting the member. Now we are also dealing with the employer. So if I can just take a step back here and also sort of just give a high level of how the funds flow between you and the retirement fund. So you have me and you that are employed by company A. We sign up to be part of the pension fund. Sometimes it's mandatory, sometimes it's voluntary. So if we sign up to be part of a pension fund or a retirement fund, the Our employer will withhold the money from our payslip and keep that money, and then collect the money from everyone's payslips and then pay that over as a lump sum to the retirement fund. So this regulation that is coming into effect is making sure that this employer, the middleman here, needs to make sure that within 7 calendar days they have paid over this money to the pension fund, so that the pension fund can now start investing the money on behalf of the employees. So the one thing is, it's good that it's protecting us as employees or as members of the various funds, by making sure that we are guaranteed that our employer will always pay the money to the pension fund, and our money is going to be paid in a timely basis so that it can be invested, because the earlier it's invested, the better it is for us. However, it has a negative consequences to the employer, because number one, if the employer is struggling with cash management, this actually puts pressure on their business, because they need to make sure that they are now paying over this money to the retirement fund within 7 business days, and failure to do so will attract interest and penalties, and which is actually, and it can be criminal offense for the employer, so which may deter employers actually requiring their members to be part of the pension fund. So it benefits us, and it also disadvantages the employer. And I think the employers might have an issue with this strict regulation, because then it also means that it's almost discouraging employers to be part of the pension fund. So we also are interested in seeing what comments the employers are actually going to be submitting around this strict regulation. Then in the next change I want to discuss is the issue around preservation. I believe we are all aware about the preservation issue at the moment. Currently, if you resign or you got retrenched, or you decide to change jobs for some odd reason, you can actually cash out your full pension fund, net of the tax implication, and go and live with your life. But what they are actually seeing, that they're saying that the current changes are trying to cater for the fact that the old regulation was passed at the time where people normally worked for one employer. But with the current workforce, with the qualifications that they have, the experience, and obviously access to information, people tend to job hop a lot, and every time they job hop, they tend not to be preserving their money. And because they're not preserving their money, that means they have less money to live on in retirement, and it puts government under pressure, because that means they need to be living on social grant that the government is currently giving. So what I'm seeing from the conversation, especially the one that was on NBC, and what I'm seeing on social media, it's not so much that preservation is a bad thing. What people are unhappy is around the percentage that is currently being preserved. So again, if your employer is asking you to comment around what preferred preservation percentage you would like to see in the proposed regulation when they come to pass, please participate in that conversation, because your view as part of your employer, your view as part of the retirement fund is likely to matter. Again, like I said, instead of you commenting on a social media post. So use the right platform to make sure that you are giving your input in a manner that is likely to be, effective. And another change that is coming into effect is the updating of beneficiary nomination forms. The FIMA Act changes would put an obligation on the retirement funds to make sure that they are sending out twice a year for beneficiaries to update their members. So I'm also going to pause here and say that if you have an investment, if you have a retirement fund, if you have a insurance policy, you need to make sure that your beneficiaries are up to date. So most of the time we join these things when we are young, when we are unmarried, when we don't have kids, and we put our parents or siblings as beneficiaries. But we then go on in life, we get married, we get kids, but we don't go back to actually update, our beneficiary. So you don't want to die and your mother is the sole, nomination beneficiary for your pension fund, for your preservation fund, for your insurance fund, whereas you have a wife and kids that are not getting anything. So you need to make sure that you are updating regularly, and I believe because this is now going to be sent out regularly, it's going to benefit members. But on top of that, if the FIMA Act change doesn't come to pass, please take time and reflect of any investment, any insurance, any retirement fund that you have, and make sure that the beneficiaries that you've nominated there, number one, you are aware of who they are, number two, and they are updated. I've also heard that there was a guy that put his girlfriend as a beneficiary on a life insurance policy. They then broke up, and the guy never went to the insurance company to actually nominate, to update the beneficiary nomination, and the ex-girlfriend got a payout. And if you are listed as a beneficiary, you can't go and dispute that the person forgot to change. The person that is reflected there is ultimately that ends up getting the money. So I think this is a positive change that is actually going to come and benefit us as members. And obviously, lastly, that I want to discuss here is the expenses that are likely to increase. With the FIMA Act changes, with the re-registration, with the trustees that would need to be educated, with member education that is likely to take place, it's going to cost a lot for the pension funds to make sure that they are reaching out to all these people, and the people that needs to be educated are all educated, and the changes that are coming from the FIMA Act changes are affected. Meaning that cost is likely to be passed on to us as consumer, meaning when we get our statement, when we see return cost incurred, that cost incurred is likely to be higher. So that eventually means that we're going to get lower returns on our investment, or the net return that we get is likely to be lower. So really those are the changes that are likely to come into effect should the FIMA Act changes come to pass. Obviously, the draft regulation may be passed with these changes, or these changes may be affected when Namfisa currently reviews the draft comments that industry players as well as me and you that are being consulted now have submitted our input, and they may amend some of the things. So all in all is I'm saying that we need to be part of the right conversation. So if your employer sends you an online survey to complete, please take time and complete. If your union sends you a survey to complete, please take time and complete. If your employer is inviting you to a meeting where workers are going to be giving their grievances on the FIMA Act, you are now aware that you are going to be affected through, the Board of Trustee appointment, you're going to be affected through the preservation rules, you're going to be affected through the mandatory contribution that needs to reach them by the 7th, and all of those things, so that when you comment, you're not just hammering the preservation rules, you are also thinking about all the broader changes into perspective. So there are a lot of changes other than this. These are just the ones that I highlighted because I believe this has an impact on me and you that would like to participate in the retirement conversation. Thank you so much for giving us your time. This is all I had from today's episode. If this is the type of content you like, please consider to subscribe and hit that notification bell so that you can be notified every time I upload a new video. And until next time, it is bye-bye.